Hey, what's going on, YouTube? Welcome back to Tech Conversations. I'm your host, Guillermo. It is June 23rd, which means it is my birthday today. Let me know in the comments section below how old you guys think I turned today. Now, as you can see, it is a green day for me, up about $200 today, or about 0.2% so far. So we'll see what the rest of the day brings us. Now, in today's video, I want to talk about another secret approach that I've been using that has been making my account grow fairly quickly and that actually also pays you twice. So this is a very interesting approach. You'll want to stick around for the entire video. And so before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. And so what our goal here is to get paid twice and also increase our max potential profit. And sometimes you can make 50% or more by using this approach here. And of course, all of this comes with unlimited risk. And this is very simple, but because it's very simple, I think it's very overlooked. So now the appropriate market forecast then. We want a neutral to modestly bullish environment. Actually, I would say more of a modestly bullish environment here to be able to get the most out of this approach here. And so the ideal stocks then will be stocks that you are modestly bullish on. And so here's the ideal situation then for this approach. So I'm going to go over to ticker symbol SKLZ. So this is skills, right? So for this approach to work, the ideal situation is that you own at least 100 shares or more of a stock. Again, you're modestly bullish on this stock here coming up, and either you're selling covered calls and you want to increase the premiums, or you want to sell covered calls, but you don't think that you're getting enough premium for selling the covered call in terms of if your shares get called away. So here's how you can implement this strategy to increase the amount of profit that you can receive by selling these covered calls. And again, very simple, but very interesting, and it definitely works. So what I'm going to do here is I'm going to go over to the options for skills. Now I've already sold my covered call for skills this week, which you can see right here. But let's just pretend I haven't sold a covered call on skills. So I'm going to go over to July 2nd. And I'm going to go to sell here. And let's pretend again, I haven't sold a covered call on skills. Let's pretend that I want to sell covered calls on skills. But let's say that, I'm a little bit nervous because, if I sell a call, for example, at the $25 strike and skills shoots up above that, I'm only getting $18 in premium for doing this, right? That may not be such a favorable risk to reward for some individuals. And I know a lot of people don't want to sell covered calls because of that reason. They don't want to sell their shares, and the premium they're collecting for it, selling the covered calls, isn't enough for them. But here's a trick that you can do. So I'm going to go ahead and let's say I'm going to go ahead and sell a call here, because let's say I'm okay selling my shares at $25 strike, but I would really like to, end up making more if it did end up going above that $25 strike and I had to sell my shares. So what I would do is I'm still going to sell this call just like you normally would. Okay, that's the first thing. You're going to sell a call there at that strike. Now what we're going to do is we're actually going to use the credit, or part of the credit here, I should say, part of the credit that we're receiving here to enter another bullish strategy as well. So what we're actually going to end up doing is we're going to sell another call at this exact same strike, $25 strike. So remember, for selling a call, you receive a premium. The premium you receive is under the price. So I'm receiving 18 cents per share here, or about $18 for each contract, because each contract controls 100 shares. I'm going to sell two of these, meaning I'm going to receive $36 now for two of them. So then what I want to do is I'm going to want to buy a call as well where the strike price is under the strike of the two calls that I'm going to sell. So down here, and where the premium that I'm paying is less than the credit I'm receiving for selling those two calls. So again, for selling two calls here, I'm going to get $36. So now I want to buy a call with a lower strike where the premium that I'm going to have to pay here is less than $36. And so the first one I see here is the 22.50 strike. So I'm going to buy this call now. Now I have to go in here and go ahead and change this to be 2 here, right? Because we want to sell 2. So again, I can do this because I have 100 shares of Skillz. I'm selling a covered call on Skillz, and then I'm entering another trade where I'm selling a call and buying a call. And ultimately, I'm using the credit I'm receiving from selling my call to enter this second trade here. But as you can see, I'm still getting a credit here, right? I'm still going to get about $8 for entering this trade. And what's going to be interesting is that later on, we're going to be able to close out of this trade for another credit. And I'm going to show you guys how that works. So now that we've seen how this looks like, let's actually take a look and see how it actually does increase your profit by a lot. So I'm going to go over to the option strat here. So really great tool here to use and visually see what's happening. So let's first take a look here at the covered call. So I'm going to go to build and I'm going to go to covered call. So let's just pretend we're just selling the covered call on its own. So here we have Skillz, and I bought my shares I bought them at 17.24. So I'm going to go ahead and say 17.24 here, right? And I'm going to go ahead and go to July 2nd here. And let's say I'm selling the call at the $25 strike. Okay, so I'm selling this covered call at the $25 strike. So my max profit is $794 here, right? My max loss, of course, 1706. That's if Skillz goes to 0, which that's very unlikely. And of course, I'm getting a net credit of $18. So here's what the regular covered call would look like, right? With my max profit only being $794. But again, some people don't like that. They think that's not enough of a reward in case Skillz were to rocket to, let's say, $30 next week or whatever. So here's what I usually do, which again has helped grow my account, and I just showed you guys. But let's take a look at what this actually looks like then visually. So I'm going to go over to a different tab, and so I'll go back to the covered call, and then we'll actually add those other 2 options that we added, and we can see how this is going to change the trade up. So again, covered call on Skillz. Again, I purchased my 100 shares at 17.24. So I'll go ahead and enter that. And again, I'm going to choose the expiration of July 2nd. So I'm selling a call, let's say at the $25 strike, right? Same thing as back here. All right. But now we're here. And so then remember, what I did was I added another option here. I'm selling another call at the $25 strike. So same strike, right? Now I can't just sell this call because that, introduces me to infinite max loss. So what I did was I bought an option. I bought a call here, and where I used the credit I received from the calls I sold to pay for this call that I bought. And for this one, I chose the 22.50 strike. So this is what it looks like. So here is this one now. So here's what I showed you guys. Here's my approach, my secret approach here that I'm using. Anytime that I want to sell a covered call, but I think it's bullish, there's a high chance that my shares might get taken away, that the price might go above the strike price. So let's take a look at what this changed now. So look at our net credit. We're still getting a credit. We're still getting $8, right? Which may not sound like a lot, but it ends up, it does end up adding up, especially if you invest that $8, compound interest, things like that. And so in $8 here, I'm still receiving a net credit. Over here, I'm receiving only $18. I'm receiving a little bit less credit. My max loss then over here is 1706. My max loss over here is 1716. So it only went up by the $10 difference. So not a huge change in max loss by doing this. But look at the max profit now. Here's my secret approach. Max profit now is $1,034 by just doing this simple trick here. If I go back here, my max profit by just selling the call is $794. So we went from $794 max profit to now $1,034 max profit. That's a 30% increase on my max profit potential just by doing this quick, simple trick here, right? As you can see, I'm still getting a credit for entering this trade. And so ultimately what's happening here, guys, is that we're selling a call. We're using the credit from that call to enter a debit spread, right? And for doing all that, we're still getting a credit of $8. And then later on, since a call debit spread is a bullish strategy, we want the stock to go up. If the stock goes up, we can sell that debit spread for a higher amount than what we paid for it. And so you're getting paid when you enter this, right? Net credit of $8, and then you'll get paid again when you sell your call debit spread for whatever that amount is, right? So as you can see, we just increased what our max profit will be here by about 30%. And again, this is a great approach to take if, again, you're selling covered calls on a stock, but you're worried that the stock might shoot up above the strike price that you're choosing, and you want to maximize, you want to make more profit on that if it does happen. So this is what I've been doing here. As you can see, max profit went from, again, 794 to 1,034. My max loss barely changed. It only went down by $10. And if you're bullish on this stock, you shouldn't really be worried about the max loss anyways. So anyways, guys, a couple of other things here, of course. One thing to note is, commission fees. Since we are opening and closing 2 additional contracts, Robinhood doesn't have any commission fees, so I don't have to really worry about that on Robinhood, but some other brokers, of course, will. And so ultimately, the downside here, of course, is that you're not getting as much credit up front, right? So over here, you're only getting $8, and over here, you're getting $18. Of course, the other downside is that your max profit is capped, of course, since you are selling a call, and your shares would get sold at that price. But of course, the upside here, right? The great thing about this is that you're going to your max profit increases by a lot. Again, in this example, by 30%. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to that in the description below. I hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.